What's up, guys? I'm Nobody Special. There was a lot of developments in the China housing market collapse today. We've got the head of the Asia Bond Market Fund over at UBS is out the door, even as UBS execs are on CNBC saying everything's all good in China. We've got developers selling off assets. We've got other developers issuing shares. And we've got CEOs and founders are making no-interest loans. And we heard from Dr. Marco Metzler again today, who says there is all-out panic at Evergrande and that watch out for those wealth management products, that hidden off-balance sheet debt. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And even though the press wants to distract you with the circuses that are going on in the media right now, the big story that we all should be watching, the collapse of the Chinese housing market, has been getting almost no attention, even though there was a lot of developments in that story today. Now, before we get into those, I have to ask you guys, could you please like this video, subscribe to my channel, and hit that notification bell? It really helps me out, and it helps me to keep this channel growing, and I'd be forever in your debt. And now it's time to shrink my big fat melon of a head and get into some of these stories. First of all, the good folks at UBS are up to their shenanigans again. First, we've got the UBS bond manager is out the door. The manager of a $3 billion Asia bond fund at UBS has reportedly left with a sizable year-to-date loss and significant holdings in China's real estate sector, including Evergrande's debt. Reading a little bit from this article here, Singapore-based Ross Dilks has left UBS Asset Management after first joining 16 years ago, Bloomberg reported. Though the Swiss firm did not provide a reason for the departure, Dilks is the lead manager of the Asian High Yield Fund, which was established about 9 years ago. Reading on, we've got Evergrande exposure. Currently, UBS is among the top 5 holders of Evergrande bonds at $274 million as of September 30th, according to public data, which includes holdings invested client money like the Asian High Yield Fund. Again, when you hear high yield, you need to think junk. High yield, junk debt. Okay, it's the same thing. You don't get high yields without high risk. The fund also has sizable positions in other troubled developers like Sunac China and Aoyuan Group. Year to date, Dilks Fund has lost around 18%, with approximately half of its holdings in real estate. You think that might have something to do with the departure of Mr. Dilks, the fact that he has lost 18% year to date and that half the fund's holdings are in the most garbage asset class in the world? Maybe. So, as there is this mayhem in this UBS high-yield Asia bond market, what do we have going on in the press? Well, here is Mr. Tommy Fang. Hello, Tommy Fang. He is the UBS head of China's global markets. And let's hear what he has to say on CNBC. Because as UBS is canning their fund managers who have lost so much money in China, what kind of story is he saying?
Tommy, do you agree with the analysis that there are 65 million empty apartments and homes in China, testament to the ghost cities, so to speak, as well? And as such, we're only at the tip of the iceberg of what is going to be an absolutely enormous problem for municipalities and their lack of ability to get extra income from land sales, for growth as well, and indeed, dare I say it, the indebtedness that's always been raised by consumers and indeed individual property companies. A lot of empty homes spells to me that there's still a big clearing mechanism still to go.
Well, in China, there are two angles we should look at it. First, I think there are growing demand driven by continuous demand and increase of living standard.
Whoa! This guy just with a straight face told you that the 65 million empty apartments in China are not a concern because there's growing demand for them. Okay, this guy is selling some serious snake oil on TV right now. Keep in mind, the guy that runs the China Bond Fund at his bank just got canned, and here he is saying there is growing demand for these apartments.
And at the same time, Chinese consumers or the savers, they are looking at property in many years as what we call hard deposit, right? So there's this demand increasing for better housing and also this so-called wealth preservation for housing as well. So I think the overall demand side is adequate. And the overall, I think here is we're looking at is some of the highly levered, property names with very high financing costs. So we need to have the confidence in the overall ecosystem to stabilize the market.
This guy was just asked about 65 million vacant apartments in China, and his response was there was growing demand because Chinese people want better housing and because people like to invest in real estate. That was his response to 65 million vacant apartments. Oh, there's growing demand. People want better houses and people like to invest in the real estate market, i.e. speculative housing bubble. You need to be careful of these bankers who are on TV pushing Chinese investments right now, especially bankers from banks that are firing the bond managers in their high-yield Chinese investment funds because they're overexposed to these garbage assets that he is right now on TV telling you are solid investments. They're not. They're some of the worst investments in the world right now. So again, you have to consider the source of this information. When you see these bankers on TV talking about China in the coming months, I want you to keep in mind which bank they represent and what that bank's exposure is to these Chinese developers. All right, because this guy is from UBS, who just canned the head of their China high yield bond fund because he's lost 18% year to date and he's still 50% exposed to Chinese real estate. And this guy is on TV with a straight face saying Chinese real estate is a good investment right now because people want better homes in China and because people like to invest in real estate. People like to use it as a savings mechanism. Well, yes, that is the problem. That is why China's housing market is a speculative bubble right now. That's not an investment case for Chinese real estate. So again, you must consider the source of the information, which bank it is and what that bank's exposure is to these Chinese developers and this Chinese real estate. And ask yourself, are they just trying to get this stuff off their books? Are they trying to convince you to buy it so they can get it off their books before everything goes belly up? Now, there's been some more developments today. We have a lot of these developers that are struggling to make their payments are starting to get creative with how they raise cash. For that, we have to shrink my big fat melon again for all you melon heads out there. And here we go. Property developer Sunac China to raise $952 million. Property developer Sunac Holdings is raising 7.42 billion Hong Kong dollars or $952 million to partly repay its debt. The company will raise a total of 5.9 billion Hong Kong dollars by issuing 335 million shares for 15.18 each, and another 2.33 billion Hong Kong dollars by selling a 5.1 stake in its unit Sunac Services Holdings, the company said late Saturday. And I also want to focus in on this part right here. Sunac also said that its controlling shareholder, Sun Hongbin, has agreed to provide $450 million to the group in the form of interest-free loans to support the business. So this is the work of the Chinese Communist Party again. What you have is a wealthy Chinese businessman who basically has a gun to his head and is being forced to use his personal funds to bail out his company. So we're starting to see patterns develop here. Now, I want to focus in on the story that Sunac is issuing shares because I just want to show you what a painful decision this must be for Sunac, because here we are. This is looking at Sunac on a one-year chart, and here we are all the way down here at $15. They're issuing shares at $15 when a year ago this company was trading at $34.75. So this is a desperate move by the company to issue shares when the stock is worth half what it was a year ago. This is a company that needs to raise cash. They can't sell their assets. They can't borrow anymore. The only thing they can do to raise any cash right now is to issue new shares and dilute their existing shareholders who are already down 50% versus a few months ago. So these folks are going to lose even more money now. This is a desperate move. And Sunac is not the only one making desperate moves right now. We've also got this Chinese developer named Aoyuan, Aoyue. This developer named Aoyuan, Aoyuan. Come on, folks, that's 5 vowels in a row. Who can pronounce that? Aoyuan. Thanks, Aoyuan. Chinese property developer Aoyuan to sell assets worth $115 million. Chinese property developer China Aoyuan said in a Hong Kong Stock Exchange filing on Sunday that it would dispose of some of the asset held in its Hong Kong units for $900 million. Note the wording here, dispose of assets. I don't know how you use the word dispose, but I generally dispose of garbage. I don't dispose of something I consider an asset. I sell assets or I liquidate assets. I don't dispose of them, but of course, this wording is not an accident because these assets are garbage. And you'll see they're getting $115 million US for it. An estimated loss of $177 million or $22.7 million US was expected from the disposal of shares in the small developers units Double Bliss, Mingwan Investments, and Prestige Well. The 900 million Hong Kong dollar sale includes sales of shares and loans. So this company is taking a big haircut on these assets, selling them for well below the value that they have on their books right now. And I mention this because we hear an awful lot that Evergrande has $250 billion in assets and $300 billion in debt. Well, as you can see, every time one of these companies tries to sell one of these assets, the going price is well below the value that they're stating on their books. So that means all of these companies that are saying they're this much in debt with this much assets, they're actually in way more trouble than they're letting on. And Aoyuan is a perfect example of this, taking a $22.7 million haircut on a $115 million sale. So between issuing new shares at well below where they were trading at a couple of months ago, diluting their existing shareholders, selling assets for well below the stated value they have in their books, and taking the personal funds from one of their controlling shareholders, you can see how these developers are getting increasingly desperate to raise the cash they need to make these debt payments. Now, another issue that's been going on, and you've heard me mention this a couple of times in my videos here, where I've been talking about off-balance sheet activities, or these secret debts or these shadow banking systems that have developed in China. And we heard from Dr. Marco Metzler at German research firm DMSA again today, and he is warning about these wealth management products or these off-balance sheet activities. And I want to bring that up now. And here we go in a post on his LinkedIn page. Dr. Metzler says, "Panic in China. Real estate developers Evergrande and Aoyue are facing massive protests from homebuyers, retail investors, and even their own employees. In the past, they have increasingly promoted so-called wealth management products to finance their construction projects. However, the collected capital is not recorded in the balance sheet. In order to attract investors for this lucrative off-balance sheet product, they guarantee high interest rates for retail investors who are now going away empty-handed." Again, folks, I've mentioned this a lot in the recent past. When you see these high yields that people are offering, run. Okay, this is not investment advice. I'm not a financial advisor. Do your own research, your own DD, arrive at a decision that's right for you based on your unique situation. But me personally, when I see somebody promising me a risk-free 15% return, I run because I know there's no such thing as a risk-free 15% return. At the end of September, outstanding claims in China's wealth management product market totaled 27.950 billion yuan, with nearly 71 million retail investors owning such products, and that's according to ChinaWealth.com. By comparison, Evergrande was previously thought to have a debt mountain of $300 billion on its balance sheet. So you can see, folks, these secret debts, these off-balance sheet activities for 71 million people in China. This is a massive problem. Reading on, he says, "We at DMSA have produced a new report on wealth management products and what they can mean for the global economy. And this is important here. The Chinese state will therefore clearly not pay for the debts of Evergrande and Aoyue to international investors, as it will be primarily concerned with getting these riots and protests under control. The collapse of a multi-billion-dollar asset management product is not only a financial problem, but could trigger social chaos if Evergrande fails to allay investors' concerns with concrete repayment plans. Yet another sign of financial meltdown." Now, I've mentioned several times on this channel, the one thing the Chinese Communist Party fears is its own people, social unrest among its own population. It does not fear the United States. It does not fear Taiwan or Japan or anything else. The Chinese Communist Party's only concern is maintaining power, and the only threat to their power is their own people. And so the Chinese Communist Party will prioritize the repayment of these wealth management products, a problem we don't fully understand yet. The retail investors that hold these wealth management products will be the first people in line to pick at the bones of these companies as they go bankrupt. That is, that and the connected party members who hold these bonds. International investors will be the last ones to get paid. All right, this debt crisis is building and building and building. Keep an eye on those Chinese banks. All right, the first sign of real failure will come when these Chinese banks stop lending money to each other because they'll be too afraid of holding the bag when the music stops. And that bag is this toxic real estate debt. Folks, I want to thank you for your time. Thank you for watching this video. Please don't forget, give me a thumbs up, subscribe to my channel, and hit that notification bell. It really helps me out. I'd be forever in your debt. In the meantime, live small and dream big.